Starting with the history of cryptocurrency in 1983, the idea of cryptocurrency is introduced by David Chuan. In 1995, David Chuan built on his earliest ideas and developed a proto-cryptocurrency called DigiCash. In 1998, Nick Salzberg introduced a reward system. On October 31, 2008, Satoshi Nakamoto published the Bitcoin white paper and describing the functionality of the Bitcoin blockchain network. Satoshi formally began work on the Bitcoin project on August 18, 2008. In April 2010, the value of one Bitcoin was just under 14 cents. By early November, the price surged to 36 cents before settling at around 29 cents. In 2012, Bitcoin price grew steadily, and in September of that year, the Bitcoin Foundation was established to promote Bitcoin development and uptake. Then known as OpenCoin Ripple was also launched that year, with the project attracting venture capital the next year. In 2013, amid federal criminal regulatory and software-related issues, Bitcoin price constantly rose and crashed. On November 19, its price reached $755, only to crash down to $378 the same day. By November 30, it was all the way up to $1,163. Bitcoin prices rose steadily year over year, going from 434 in January 2016 to 998 in January 2017. A software upgrade to Bitcoin was approved, with the aim being to support development of the Lightning Network by December 17, 2017. Bitcoin reached an astronomical all-time high of just under 20,000. Next, we will discuss about the concept of the blockchain. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. Blockchain also is a shared immutable ledger that facilitates the process of recording transactions and tracking assets in a business world. Each block in the chain contains a number of transactions, and every time a new transaction occurs on the blockchain, a record that transaction is added to every participant ledger. Blockchain is a type distributed ledger technology in which transactions are recorded with an immutable cryptography signature called a hash. How the blockchain works. For proof of work, blockchain, this technology consists of three important concepts, which is block, knobs, and miners. Every chain consists of multiple blocks, and each block has three basic elements. The data in the block, the nonce number used only once. A nonce in blockchain is a whole number that randomly generated when a block is created, which the generate a block headers hash. The hash is a hash in blockchain is a number which permanently attached to the nonce. For Bitcoin hashes, this value must start with a huge number of zeros. When the first block of a chain is created, a nonce generates the cryptography hash. The data in the block is considered signed and forever typed to the nonce and hash unless it's mined. What is a miner in blockchain? Miner create new blocks on the chain through a process called mining. Miner use special software to solve the incredibly complex math problem of finding a nonce that generate an accepted hash. I have chosen Bitcoin as the cryptocurrency, and that I will elaborate in this video. Bitcoin was launched in 2009, and it is also the largest cryptocurrency in the world. Unlike fiat currency, Bitcoin is created, distributed, traded, and stored using a blockchain. Bitcoin and its ledger are secured by proof of work consensus, which is also the mining process that introduced new Bitcoins into the system. Nowadays, Bitcoin can use as a payment method but you need to have cryptocurrency wallet. Wallets hold the private key to the Bitcoin you own, which need to be entered when you are conducting a transaction. Bitcoin is accepted as a means of payment for goods and service and many machines, retailers, and stores. An online business can easily accept Bitcoin by adding this payment option to its other online payment options such as credit card, PayPal, and etc. Bitcoin can be used as investing tool also. Investors and speculators become interested in Bitcoin as it grew in popularity between 2009 and 2017. Cryptocurrency exchange emerged that facilitated Bitcoin sales and purchase. Traders began using Bitcoin or cryptocurrency exchange to make short-term traders, and the market took off. Next, we will talk about the features of Bitcoins. First, it's fast and it can send in any amount of money in matter of minutes, regardless of destination. And second, it is inexpensive because the lower cost of making a transfer. Third, it's global. You can send Bitcoin to any country in the world. Four, encryption and distributed make Bitcoin become very safe, and it has at its core and it in each of operation. Fifth, transparent. All transactions are public. What is Lightning Network? Lightning Network was first proposed by Joseph Poon and Thaddeus in 2016. The main purpose of Lightning Network was devised to solve was Bitcoin's slow transaction time and throughput. The importance of Lightning Network enabling faster and cheaper payment massively improves scalability and better privacy without compromises to censorship resistance and decentralization. How Lightning Networks work? A Lightning Network channel is a transaction mechanism between two parties using channel. The parties can make or receive payment from each other. Transactions conducted on the Lightning networks are faster, less costly, and more readily confirmed than those conducted directly on the Bitcoin blockchain. Between the opening and closing of channel, parties can shift funds between themselves as needed until they close the channel. Once the channel is closed, the transactions are sent to the mainnet for confirmation. Next, we will talk about the market performance of Bitcoin in 2017. Bitcoin breaks 1,000 and kicks off a bull run. After years of price fluctuation ranging between 100 and 900, Bitcoin finally broke 1,000 again in January 2017. While international diplomats, government mathematicians discuss cryptocurrency regulation and mainstream adoption, Bitcoin price moved sideways during this time, with a few small spikes. The highest peak was in January 2018, around $17,527. The lowest dip was around $3,236 in December 2018. In 2020, due to the coronavirus pandemic shut down the economy and stirred out fears of inflationary pressure on the US dollar, Bitcoin price started to accelerate in its outward climbs. By December 2020, Bitcoin price had increased by over 300% since January. The year ended at a price of about $29,374, the highest it had ever been. Bitcoin doubled its value in 2021, but in January 2022 saw a big drop that erased almost all of the previous year gains. We saw Bitcoin skyrocket to an high over 64,000 in the first half of 2021, then just as quickly fall back below the 30,000 over the summer. The future of Bitcoin. According to Crypto News, Bitcoin price in 2022 would exceed 70,000 and stay steady at that level. Crypto News predicted Bitcoin maximum track value would be around 85,000 in 2024. Based on Changelly.com, Bitcoin price will rise even higher in 2025. The site predicts that Bitcoin will be traded at $134,520.58. Next, the advantage of cryptocurrency. First, it's secure and private. Blockchain ledger is based on given mathematical puzzle. It is also hard to decode. Second, increase in value. Cryptocurrency have the potential to increase in value quite a bit than the fiat money. Third, irreversible transaction. Most cryptocurrency have irreversible transaction, so machine who accept crypto payment don't need to worry about the chargeback. Disadvantages of cryptocurrency compared to fiat money. First, high volatile. Cryptocurrency is high volatile and even the largest coins can lose half their value of more in a matter of months. Second, they are full of scams. The world of crypto is full of scams. This includes crypto pump and dump schemes and scams that target investor exchange accounts such as phishing tests and emails. Consequence of serious mistake. Cryptocurrency doesn't offer much protection if something goes wrong. For example, if you send crypto to the wrong address or lose access to your blockchain wallet, there's no way to get back it. The crypto in the long term is loss free. Long-term strategy and taking the long-term view, not incurring any trading fee. Higher risk of losing access to private key. There's a higher risk of losing access to private key, which are essential to asset protection. Third, require higher capital. Investor must ensure they have sufficient capital at their disposal in case of forced sell or unexpected liquidity needs. Cryptocurrency in the short terms require less capital. In the short term, trading field can make profit or a small amount of capital. It removes the pressure of requiring a bigger capital just to accumulate profit. Market active. Short-term crypto investments are available for anyone at any given time. Leverage recent trends. Users watch the market and make sound decisions based on their findings. The mogul declined to use Bitcoin because of the environment harm it caused during the mining process. This is the list of reference. Thank you.